There is no shortage of money out there. Folks, I'm Justin Hitt with Sustainable Wealth Secrets. I recently saw a report this morning before I headed out today, and I got a little delay, so don't mind the background, but majority of banks, so we just had a Silicon Valley Bank crash, and they found out that 82% of the accounts were over the $250,000 FDIC insurance coverage. Now, again, if you're running a business, it's easy to do that because you have payroll and different things. But there is a report that came out about the percentages of banks who have accounts that are within the threshold of the FDIC insurance. And it turns out a lot of banks, like the highest number was 72%. So 72% of the accounts were below the $250,000 threshold. But majority of the banks were like 30 to 45%, meaning the minority of accounts were under the FDIC threshold, meaning there's a crap ton of money out there, meaning people have bank accounts with more than $250,000 in it in the majority of the cases. So let's say 50% of the bank accounts have more than the FDIC insurance. Now, it could be bad decisions. It could be not understanding the insurance, but it could be there's a crap load of money in cash. Now, what does that mean to you? Well, if you're going to build wealth and you're receiving income, you've got to utilize it. Because if the majority of people are just letting the money sit around, then there's a lot of money out there to get as clients, but there's also a lot of money that's not doing anything. And so they're not building wealth. They're not building cash flow. They're not investing in assets to cash flow. They're not building up cash protection. We have a program called the Cash Parking Plan. You don't just park your money in the bank and get like 1% interest. You need to have that money. So the FDIC insurance insures an account. So if you have $250,000 in the account, it'll cover that. If you have $250,000 in each account in 50 different banks, it'll cover that too. But if you have $500,000 in one bank, it's only going to cover up to $250,000. So I hope that makes sense to you. You can go to the FDIC's website and they'll explain it. And FDIC is Federal Deposit Insurance Company, and that's only available in the United States. Other countries have something different. There's also an SPIC, which is like securities protection. But essentially it's insurance, so if the bank fails, you're going to get your money back. Because banks use fractional lending, so they can have $1 deposit and they can lend out multiples of that. But see, the bank is going to incentivize bigger bank accounts by having certificates of deposit, by having high yield savings accounts, but it doesn't mean your money's safe. So some people think the bank is the safe option when it is not. Some people think their 401k is a safe option when it is not. You may not know that 401ks are actually on the balance sheet of the business that you're working for. And so they kind of own your money until you transfer it to a brokerage or something like that. But the organization can borrow against your pension account, against your 401k. So again, what are we doing here? Financial education is number one. Okay. You have to understand, is your money secure? You don't want to lose your money to identity theft. You don't want to lose your money to a bank failure. You don't want to lose your money because you got to make it back. And it took you time and life to make the money. So let's be conservative about it so that we can keep it. I don't know if you guys notice, but I'm just kind of look like a regular guy. And, I'm experimenting with this intentional thrift. I've done that all my life. I like to see the money cycle. So I want that dollar to circulate rather than to just go away from me. I don't want to buy expenses. I want to buy opportunity. These are concepts that you need to educate yourself about. Otherwise, you're going to be like the majority of the people, either have little or no money in the bank, or you're going to have too much money in the bank that could otherwise be serving your interest. Now, a business is different. A business can have $250,000 in the bank because you're backing a loan. It could have $1 million in the bank because you got to meet payroll. But there are ways of understanding this. It's called treasury services, and in your organization, your financial manager is going to need to keep that money moving. Okay? It's got to float in the system. There are cases where you may have $1 million in a brokerage account, and you may have $250,000 in your regular everyday service account, but every week having to refresh that account so you can stay ahead of things. Now, there's floats. That's another concept that we've talked about. But your reserve fund has to be, a lot of times on your books, your reserve fund will be spread across multiple accounts. So if you need a $2 million reserve, you could be lazy and put that all in one bank. Or you could be smart and you could have a certain amount in the bank that's covered by insurance. You could have optional insurance to cover it. You could have actual long-term insurance. The perception is that banks don't fail. But if you look at the history of banking, there's been banks that divest organizations. There's banks that buy out organizations. There's banks that have risky practices. There used to be all kinds of companies. Even Goldman Sachs was multiple different companies that it spun off or bought. Wachovia, it became Wells Fargo. Banks can fail. Now, they can also get bailouts from the government, which gives the perception that they're too big to fail. And then if they do fail, the government will save them. But it's still your tax dollars. And ultimately, the government's not saving them because they're just looking out for their own interests. So again, spread the money around in circulation, not just putting it in a bank account somewhere. And I know that the money in the bank is not necessarily in a checking account. It's not in a zero interest checking account. It could be in a sweep account, for example. So there's a high yield savings and a certain amount of money sweeps over to the checking every day, every week, every month in order to meet obligations. There's many ways of doing it. That's called treasury services. But in your own business, so you got a high income, your $10,000 paycheck drops, you don't want the money to stay in your bank account. First off, most checking accounts are forward facing, meaning if you've ever used a debit card or you ever use a credit card transaction, so you paid your credit card from that checking account, it's open to identity theft. So you want to keep only a month and a half or about a month of expenses in your checking account. If that happens to be more than $250,000, then you want to think about narrowing the time frame in which you keep the money there. So you keep $249,000 and you know that every week that money's got to come out, or every 2 weeks the money's got to come out. But anything over a certain threshold gets rolled into investments. So I don't have it off the top of my head, but I do know brokerage firms have a higher threshold for insurance. Now, do you even need insurance? Yes, Lehman Brothers and the list of failed banks is longer than the list of actual banks that remain. Okay, banks can fail. The Federal Reserve can fail. In other countries, their central banks have failed before. So you have to think about this. What's my risk? What's my potential for failure? And it can be high if you are concentrating that risk in a single organization. I tend to like regional banks rather than local banks. But a local bank, you can drop $500,000 in a local bank and go in there and borrow $500,000 back out. And now you've got the money invested, their whatever their high yield is. And then you've got a loan. And in some cases, their high yield pays a better rate than the loan because they can fractionally lend it out, and they're lending at higher rates than typical. So you can drop $500,000 in there. Actually, I think I talk about this in one program. As this guy was explaining to me, he would drop like 100 back when FDIC was 100,000. So he would drop $100,000 in an account. And then he'd come back a couple months and borrow $50,000. And then a couple more months, borrow another $50,000. And then in a couple more months, borrow another $50,000 for his business. Now he's paying all this money back, but the loans were interest only. And so he would basically use this to finance the business, but the banks would be more comfortable with it because he's got this $100,000 there. But he would get into multiples of that $100,000 borrowed back out on these incrementals, and he'd be paying them off. And he had somebody in the office that was managing all this. But he figured out the money, the interest he was getting off of these certificates of deposit. So he would ladder the certificates of deposit. The interest he was getting from the certificate of deposits was less than the interest he was paying on the line of credit, and it gave him leverage. Because he only had $100,000 in cash in the beginning, and he turned that into $200,000 in the value of money over time. So he could use the money over time. Also, it built up a solid relationship with the bank so that if he needed a larger loan, or he needed financing for a new deal, or he wanted to get some equipment leases, it just was a no-brainer, and local banks were good for that. The problem is local banks fail a lot. Regional banks, probably you can still use that structure today. But do you see my point? The math shows you there's lots of money out there. Banks have the minority customer especially in commercial banks, the minority customer has low balance accounts. The majority of the customers have high balance accounts. Why aren't you getting that money? Why aren't you offering products and services and solutions that will help them keep that money moving? My financial services folks that are on the newsletter, that money needs to be invested. The biggest risk is to rely on the FDIC and to rely on the insurance. And so even a marketing campaign about the risk of FDIC insurance, every year you're going to get an example. Every year banks get shut down. Every year banks go into receivership. And so that's a good news point to persuade individuals to invest their money, which increases your money. Now, I don't want you to put them in money market accounts and stuff like that, or bonds and things that pay you a lot of commission. It's not about you getting a commission. It's about serving the customer. So again, you may not be saving money by leaving it in the bank. Banks do fail. Money's got to circulate, and it doesn't circulate collecting dust in your bank account. It will lose against inflation. And number 3 is that the money has a structure to it. And if your structure produces more income and produces more opportunity, then it's a good structure. But if the structure is stagnant and it's not easy to manage, and it puts you at risk of having too much money in one location, then you can have problems. The last thing I want to leave you with is the structural, having money at multiple banks, even different tiers of banks, commercial banks versus credit unions versus whatever, gives you choices if you ever have your account seized. Not that I've ever had my account seized, but I have known when a bank fails, they've locked the accounts out, and now the business can't get any cash. So a buddy of mine a long time ago had this business, construction industry. The bank had some problems and locked up his money. And so this is his money in his checking account that he can't access because the bank's having some problems. But fortunately, he had money at a different bank, and he could just go get the money from a different bank. So you need to, 1 is none, 2 is 1. So you do need to spread the money out a little bit. It's a little bit more overhead and record keeping, but it can, you can have an account just for payroll, and you can have an account just for administrative overhead. You can have an account just for, R&D projects. A lot of banks will try to get you to put that account all in one location, and then in your bookkeeping, you just segment the account. But then you end up having too much money in one location. It's a benefit for the bank because they're lending it out at multiples, but it's not a benefit for you if they're doing that in a risky way. I'm Justin Hitt with Sustainable Wealth Secrets, and I hope you've picked up something useful here. I sincerely am driving hard to make sure you have too much money in your bank account so that you can turn around and circulate that in the economy. There's plenty of money out there, and if times are a little slim right now, that's okay. We talk about sustainable wealth that's going to survive for a long term, and part of that is the education that you're getting. Part of that is the practical application of that education, and ultimately, the time wealth, the profits that are not measurable on a balance sheet, which we ideally. I find that when you get your mindset right and you have your, you're comfortable, but not too comfortable, you tend to accumulate more wealth. And again, the wealth is for your future self. Your wealth is for taking care of your family, taking care of your community, and being a valuable contributor in the societies in which you participate. I'm Justin Hitt with Sustainable Wealth Secrets, and this has been another podcast episode. I hope to see you in the next podcast. And between now and then, if you have questions, visit me at www.sustainablewealthsecrets.com. Go to the contact page and ask your questions. If you want to join our free newsletter, go to the newsletter page. There's all kinds of little links on the page. And I hope to hear from you soon. Until next time, I'm Justin Hitt with Sustainable Wealth Secrets.